When a market crash happens, there is one phrase that appears almost immediately. This time is different. You hear it in the news. You see it in headlines. You hear it in conversations between investors, analysts, and everyday people watching their savings fluctuate. Every crash seems to arrive with its own explanation, its own specific cause, and its own feeling that something fundamental has shifted, that the world has crossed a line it cannot uncross. And in the moment, that belief feels reasonable. Think about the last century of financial history. In 1929, people blamed rampant speculation and the end of the Roaring Twenties. In the 1970s, the problem was stagflation, rising prices combined with a stagnant economy driven by oil shortages and geopolitical instability. In 2008, the crisis centered on housing, banks, and complex financial instruments few people truly understood. And in 2020, markets collapsed in response to a global pandemic that shut down everyday life. Each of these moments looked completely different on the surface. Different industries were affected. Different institutions failed. Different fears dominated public conversation. And because the cause was different, people assumed the outcome must be different too. But for the people living through these events, the emotional experience was strikingly similar. Confusion, uncertainty, doubt. Market crashes are rarely recognized as crashes while they are happening. They don't arrive with a warning label. They don't begin with a clear announcement. They don't feel like history in the making. They feel like disorder. At the beginning of a crash, prices fall, but not all at once. You might see a sharp drop, followed by a strong rally. Then another decline. Then another bounce. Each movement creates a new emotion: fear, relief, hope, doubt. Bad news dominates headlines one day. The next day, reassuring commentary appears. Experts disagree publicly. Predictions shift constantly. Nothing feels final. And because nothing feels final, people hesitate. During these periods, investors search desperately for clarity. They check their portfolios more often. They read more news. They watch more analysis. They're not necessarily looking to act. They're looking for confirmation. Confirmation that selling is the right move. Confirmation that holding is safe. Confirmation that waiting is justified. But markets don't provide confirmation on demand. Every crash begins with a story, and those stories are always convincing. In 1929, technological progress made people believe prosperity was permanent. In the 1970s, inflation made people believe growth was over. In 2008, systemic risk made people believe the financial system itself might collapse. In 2020, a global shutdown made people question whether markets could even function. Each explanation felt logical. Each explanation felt grounded in reality. Each explanation felt new. And because the story felt new, people assumed history no longer applied. This belief that this time is different is not stupidity, but it's psychology. Human beings are wired to respond to narratives more than numbers. A compelling story can override data. A convincing explanation can overwhelm long-term thinking. A powerful fear can make patients feel irresponsible. And once that narrative takes hold, uncertainty begins to feel permanent. Markets don't repeat exact events. They repeat human behavior: fear, hope, panic, relief. They repeat the same emotional cycle over and over again, even though the cause changes. Every generation experiences its own version of this cycle, and every generation believes its experience is unprecedented. As uncertainty grows, many investors do not panic immediately. Instead, they freeze. They delay decisions. They wait for more information. They tell themselves they'll act once things make sense. I'll get back in when things calm down. I'll invest once the future is clearer. I'll wait until the experts agree. But clarity rarely arrives on time. History shows that recoveries often begin quietly. Markets stabilize before headlines improve. Prices rise while fear is still widespread. Confidence returns only after opportunity has passed. By the time things feel safe again, markets have often already moved significantly higher. The emotional signal always lags the financial reality. Looking back, crashes appear obvious. Charts are clean. Timelines are clear. The outcome feels inevitable. But that clarity didn't exist in real time. Hindsight compresses uncertainty. It removes confusion. It erases the emotional weight of living through the moment. This is why past recoveries feel easy to understand and future ones feel impossible to imagine. Understanding this pattern doesn't eliminate fear, doesn't make uncertainty comfortable. It doesn't make crashes painless. But it can help you recognize the experience when it happens. That feeling that the rules have changed forever. That belief that history no longer applies. That instinct, that waiting feels safer than acting. Those feelings are not warnings. They are the signature of every major market downturn in history. Market crashes feel different at the time, not because history has changed, but because perspective hasn't arrived yet. Hindsight is always perfect. But investing requires living in foresight. Learning to exist in that gap between uncertainty and clarity is one of the most difficult and most essential skills in long-term investing. This is the Long View Finance. You'll find more videos here exploring money, markets, and financial history.